It's the 3rd of November, Monday. Welcome to another edition of Monday Market Picks. My name is Thilan Wickramasinghe. I'm the head of research for Maybank Securities here in Singapore. Now, the countdown to the year end has begun. Normally and historically, this is a season where we see market momentum turn positive as we carry through to the end of the year. Will that be the case in 2025? That's something that we will need to watch out for. Now, if that holds true, we are going to be featuring a stock that's going to be a direct beneficiary of that market momentum. Fintech player IFAST. We've got analyst Zuan Hao, who's just initiated on the stock with a buy, so we'll have him on the show in a little while. Next, our macro team has upgraded Singapore's GDP to 4% growth for 2025, the highest on the street. Husseini thinks that Sheng Siong is one of the best proxies to play this theme, and we'll explain why later on in the show as well. Then we have a special guest, Tim Phillips, founder of Tim Talks Money and a SGX Academy trainer, who's here to discuss the software as a service and IT services sector on SGX. And he's got a key feature on AvePoint as well. Plus, we've got two fresh trading buys from our chart guy as well. So a lot to go through today. But let's start with IFAST and Zuan Hao. Zuan Hao, welcome to the show. Now, you've initiated on IFAST with a buy and a target price of 11.95. Now, before we talk about the investment thesis, can you briefly take us through the different business segments of IFAST?
Yes. Hi, morning, Dylan. Sure, of course. So primarily, iFast is a fintech wealth management company. So they mainly operate in Singapore, Hong Kong, Malaysia, China, and the UK. So iFast operates five core business divisions, of which four of the divisions belong to their wealth management platform. So they are namely the B2B wealth management platform serving financial advisors and institutional clients, the B2C investment platforms, primarily to its Fund Supermart FSM1, serving retail and high net worth investors. While it's recently acquired iFast Global Bank, or IGB in short, which is situated in the UK, serves as their latest division. So they provide digital banking services, which offers multi-currency deposits, remittance, banking as a service, all with an easy account opening process. So actually, this is important to take note that all of these divisions are not standalone, but seamlessly integrated with one another via its in-house account linking platform, which they call it iFast Bridge. So IGB users actually can seamlessly open wealth accounts to transfer funds to their iFast wealth management platform and vice versa. So we see this as a positive, and we believe this will encourage spillovers into its AUA, where IGB aim is to actually enhance iFast fintech capabilities rather than just acting as a standalone bank.
Got it. Now, your forecasts are pretty punchy, ahead of consensus, and you've got a pretty punchy target price as well. So what's driving your optimism?
Yeah, so we're slightly ahead, and the reason for this optimism is that firstly, we believe that IGB is still an asset, not realizing its full potential yet. And we believe that AUA growth will surprise on the upside, given the ongoing rollout of its Hong Kong e-pension project and the macro tailwinds and the EQDP reforms that you have mentioned earlier that will fuel AUA inflows into Hong Kong and Singapore, so driving its wealth management business further. So on the IGB front, in the short term, we see that it is doing better than expected given its turnaround profitability. So IGB actually turned profitable back in 4Q24, but the profitability has sustained quarter on quarter as of 3Q25. So the deposits have surged about 92% as of 3Q25, and we project this to more than double to 2.6 billion by full year 2026. And in the long term, we expect that there's better cross-sell opportunities to be realized within the fintech ecosystem, as I've mentioned, with the seamless integration via iFast Bridge. As for its AUA growth that will surprise on the upside, we see that its Hong Kong division, the e-pension rollout, remains on track. As of October, 17 of the 22 trustees have been onboarded with estimated full onboarding by 1Q26, which will pave the way for full year revenue recognition in FY 2026. While the macro tailwinds in Hong Kong and Singapore, we see that there are record ADVs being recorded within the Hong Kong exchange and the Singapore exchange, and we note that these record drive and record ADVs are actually growing in tandem with IFAST's Singapore and Hong Kong segment revenues. So we believe that this will actually spill over to IFAST business segment as a result of heightened market participation and interest in both Hong Kong and Singapore, and this will result in higher AUA growth in both market segments.
Got it. Now, what are the next catalysts that we should be watching out for in this stock?
I think in terms of next catalyst, it's still a bit more, we're still a bit more cautious. We believe that, the next catalyst will still be the ongoing IGB's full year profitability for FY 2025 and 26. So we'll have to see whether 2026 they hold on to a full year profitability as well. And on top of the e-pension scheme, the full onboarding of Hong Kong's e-pension trustees will be one of them. But management has also hinted to us that Macau might be the next frontier, but not much clarity given on that at the moment. So we'll be a bit more cautious on that for now. Yeah, and then there'll be certain key risks involved. So primarily in terms of where we see execution risks at IGB delaying profitability, and then there might be cost overruns or delays on top of the Hong Kong e-pension scheme. Previously, they have sort of reduced their PBT targets because of the costs overrun, where they needed to hire more staff because of onboarding schedule deadlines. So we are wary of that aspect. So that might be one of the risks. And then the third risk probably would be the adverse market conditions reducing AUA significantly.
Got it. Now, I note that as a high-growth fintech, globally, high-growth fintechs trade about 40 times PE. IFAST is around 29 times now. So fairly still quite a bit of valuation gap between the global peers and IFAST. So buy on the stock. So do have a look at our full note in our newsletter today. Now let's move on to Sheng Siong, which is having a very strong day today post their third quarter results. Stocks nearly up about 6% so far. Hussaini has reiterated a buy call on Sheng Siong, highlighting strong and sustainable momentum going into 2026. We forecast revenues and earnings to grow at an annual rate of around 8 to 9% between now and 2027. This growth is supported by resilient macro conditions, steady consumer spending, a meaningful opportunity to gain market share as one of Sheng Siong's key competitors are continuing to scale back their operations. Now, what's driving the momentum? Expansion. Sheng Siong has already opened 10 stores, new stores this year. One more is on the way, and we plan for 7 additional outlets going into next year. What's interesting is that the company is moving beyond their traditional focus on heartland HDB locations and venturing into mall-based stores, a move that could broaden their customer base and lift brand visibility as well. Also factoring in strong third quarter results, revenues up 14% year on year, and earnings are up 12% year on year. We've raised 2025 to 2027 earnings forecast by 6 to 7%. Target price has also been upgraded to 255, implying about a 13% upside from the last close. Now, despite trading around 20 times forward earnings, which is in line with peers, Sheng Siong will still offers fairly superior growth and margin profile, supported by its efficient operation as well as a rock-solid balance sheet with zero gearing. On the macro side, this is something that we've been highlighting quite a bit on Singapore. It's very, very favorable. Population domestically is expanding, particularly from foreign workers. Government support programs like SG60 and the CDC vouchers are keeping household spending healthy. The ongoing housing boom means more HDB projects, and that translates into more retail spaces potentially for Sheng Siong to expand into. So overall, Sheng Siong combines reliability of a consumer staple stock with the earnings growth of a mid-cap expansion story. So investors looking for a defensive name with very clear growth catalysts, Sheng Siong looks like a pretty steady winner going into the longer term. That's why we are keeping a very solid buy on this stock, and we think that the company is on the right side of Singapore's growth story. So there's a lot more of that in the newsletter today, so do have a look at that. Now, with that, let's turn our attention to special guest Tim Phillips, who is joining us as a special guest. As I mentioned earlier, Tim is the founder of Tim Talks Money, and he's also an SGX Academy trainer. He's here to talk to us about the software as a service and cloud stocks listed on the SGX. Tim, welcome to the show. So let's start with the software as a service and cloud stocks and their business model. Why are they so attractive to investors right now?
Thanks for having me, Dylan. Well, I think the main thing to remember with cloud stocks is that they generate recurring revenue, right? And who doesn't like recurring revenue? I think the problem with a lot of these old economy type businesses is that they have a lot of lumpy revenue growth or lumpy revenues, and there's not much visibility into terms of how much of it is recurring. So for example, property developers, they build a development, they get a whole load of income, and they recognize the revenue in one period, but then the next year there could be a downturn and they just get whacked, right? So I think with recurring revenue, what you have is you are building a moat basically into your service, and you have a lot more revenue visibility over sort of the next 3-4 quarters, as well as the next 12 to 18 months. And what is so great about cloud stocks, or at least in the SaaS business, is gross margins, right? And we all know gross margins, the more higher the gross margin, the more of your dollars are going towards the bottom line. And so with SaaS, the incremental value added from another client is basically zero, right? You're just scaling. And so having not to deal with physical products, it makes it a lot easier. So SaaS, in terms of their profitability, it's no exaggeration to have gone back to what Mark Andreessen was saying in the early 2010s, 2012, is that software is eating the world. And that's pretty much true, because it's taken about sort of 6 to 8, 9 years for cloud and software to really come into its own, since around 2012, 2013. And even today, around 50% of global IT spend is spent on cloud and SaaS. So cloud and SaaS actually have a bit more of a runway for internal IT budgets to spend on. And so this is a story that is going to continue to play out, and I think will probably accelerate with the rise of Gen AI and broader artificial intelligence as well.
Got it. Now, actually, so I want to focus on a particular stock, and AvePoint is one of the stocks I really want to focus on. This is one of the newest companies to dual list on SGX back in September. Now, before we talk about the stock, Tim, can you explain what dual listing means and what are the differences investors should be aware of companies listed as a primary listing versus a dual listing on mainboard SGX?
Yeah, so I mean, I think for the SGX, what they count as a quote unquote dual listing is actually just basically a secondary listing, right? I think they say secondary listing, and it's basically a dual listing. So AvePoint actually went public on the NASDAQ via a SPAC in sort of November 2020. And then it went public here via a secondary listing, or by way of introduction, in sort of mid-September of 2025. So it's been public in Singapore for about 6 weeks. And the main difference with a secondary listing is that you don't have all the requirements that are put onto companies that have the SGX as their primary listing home. So basically, by way of introduction for AvePoint, they're still they're still required to adhere to the listing rules of their primary home market, which is the NASDAQ, which is the US. So that oversees everything in terms of compliance. Singapore's markets will then make some exceptions for companies that do have a secondary listing here. So they don't have to adhere to all the compliance regulations, or rather listing rules that a lot of main board companies would have to, or the ones that have Singapore Exchange as their primary listing. So that's the main key difference, I think, for investors to understand. Beyond that, obviously the trading currency that it's in terms of the stock. Although fortunately for Singapore investors, the share price of AvePoint is actually in Singapore dollars. It's not in USD, so it's easier to trade, I feel, for Singapore-based investors, given it's in a local currency. I know we have a lot of these newer stocks or newer ETFs that have dual listings or dual currency listings, but this one is just a Singapore dollar listing of AvePoint shares.
Got it. So you can trade AvePoint on local time zone in Sing dollars. So that's, I think, a key benefit. So what does AvePoint do, and what sets them apart from their peers?
Yeah. So do you mind if I just share a couple slides quickly, like with the audience?
Go ahead.
Yeah. Okay. Yeah. I'll just share quickly and kind of go through this, because I think it's easier if I just visualize it for your audience. Okay. Can everyone, you can see, right? Okay.
Yep.
Yeah, you can see, right? Okay, cool. Okay, so I'm just going to go through basically what AvePoint does. And at the core of it is really just data cloud security and sort of governance, as well as data replication, risk, compliance, all the things that are essential, I think, for companies. So I think when you talk about cloud and data security right now, cybersecurity is one of those really big thematics that everyone is saying is critical, right? It's one of those spends on CIO or CTO budgets that really can't get cut. And so AvePoint really taps into that. And the TAM for the total addressable market over the longer term is huge for AvePoint. And as we know, what The Economist said back in 2017, data is the new oil. And actually, data is the new oil as a quote is from 2006. It was actually attributed to a mathematician talking about just how data is so crucial to everything that is going on, I think, in general, I guess, mathematics, but physics, but also now in the online world, right? Data and how we slice it, how we dice it, and also how we compartmentalize it to ensure that you're compliant for data reasons, as well as you're using the data in terms of your actual overall business. And so that's what they do. They basically provide data cloud SaaS solutions for clients. And the main thing is that they're growing their customer base, right? So they've gone over around 21% CAGR over the past 2 years in terms of growing their customer base. So they've tried to diversify their customer base over the past couple of years, and they're doing a good job of growing overall customers. Fast growing in Asia, as you can see in its latest 12 months, in its Q2 result, rather, APAC is the fastest growing in terms of ARR, which is annual recurring revenue, which you like to see. APAC is still the smallest in terms of the overall pie of revenue, but in terms of growing ARR, it's the fastest region. And so we like to see that it's moving further away from North America and moving towards APAC. But I think part of this reason that they actually listed in Singapore was to raise investor awareness about their products in Asia and just get people a bit more interested in AvePoint services. And the good thing about AvePoint for me is that it really has direct access to decision makers within organizations, and especially at the top range of the enterprise, which is what you want. You want direct engagement with CTOs, CIOs, the decision makers who set IT budgets, and that's what they have. So over 50% of total ARR is actually focused on enterprise, which is the really big companies, right? The ones who have 5,000 plus employees. And that's where the budgets are going to be set. That's where the big money comes from for budgets, for IT budgets, and they're tapping into that sector. So you like to see that as well. Metrics trending all in the relatively right direction. Gross margins rising, gone up from 72-ish% to 75.5% over the past couple of years. Operating income as well is rising. It just turned profitable earlier this year, which is great. 2024 actually recorded net loss, but it turned profitable Q1, and Q2 actually recorded a GAAP net income in both quarters. So it's trending in the right direction for the actual business as well. And then strong free cash flow, right? This is what we want to see from a business, because tech businesses, everyone's always talking about being loss making and not being able to generate free cash flow. But actually, AvePoint's been able to grow it relatively strongly over the past few quarters. And as you can kind of see, free cash flow margin now sits at around 22% as of the latest quarter. Just add in a little thing from my favorite show, Succession. Microsoft is their main customer. So I will just clarify that for AvePoint's stack, or who they serve, they're much more focused on Microsoft and M365. So that's talking about SharePoint, Office Suite, 365. So everything in terms of Microsoft's corporate enterprise suite of products, they serve that, and they go throughout the whole stack. So instead of serving a lot of different types of clouds, they're really focused on Microsoft. They're kind of very specialized. And I think we know Microsoft is doing very, very well in the cloud and in AI. So for them to be the sort of go-to partner for data security and data governance for Microsoft's suite of products, I think is a big boon. But as we'll cover in a bit, it can also be a double-edged sword. It can be a risk. Okay, so I like to use a lot of data from CIO surveys, and Morgan Stanley runs a great CIO survey every quarter. And what they do is they talk to CIOs in big corporates. They ask them what are their spending plans for the next coming quarters, and also the next maybe 12, 18, 24, 36 months in terms of budgets. And we can kind of see who is going to be the big winner over the next 12, 24, 36 months from Gen AI. And we can kind of see Microsoft has really pulled ahead in the past couple quarters. So as you can kind of see from Q3, latest Q3 CIO survey, you can kind of see what vendors that they see gaining the largest incremental share. And CIOs are looking at Microsoft at 37% on Gen AI, and vendors gaining the largest incremental market share just in 2025 from Gen AI. Microsoft's pulling ahead as well. And so I think we've kind of seen that play out, right? They've got a great partnership with OpenAI, but they're also starting to build their own internal AI capabilities as well. And their cloud is growing like gangbusters. Azure is just absolutely crushing it. And they're going to be one of the big winners. And so that is definitely going to benefit AvePoint, because we're going to see more business flow, hopefully, through to AvePoint and the demand for what they're providing clients. And software security, I'll end up, this is pretty much the end. Software security isn't going to go anywhere. We can kind of see from the latest survey where most people are expecting to spend, and software is continuing to grow by sector. It's ahead of communication services, hardware. And on the projects with the largest spend increase, AI, ML, security software, they're the top, and that's not going to change because, again, cybersecurity is mission critical for organizations. They can't live without it. And then AI, ML, everyone's putting money into that, and that's going to continue to grow. So I think for AvePoint, all the structural tailwinds are in the right direction for them. And that is going to be critical, I think, in the next 12, 18 months as this AI story continues to play out. And then finally, give me a follow on socials. Got to plug myself a bit here at Tim Talks Money SG. And that's it. Yeah, so thanks for that. Hopefully that answers a few of the questions or that people have on AvePoint.
No, brilliant, Tim. That's very, very clear. I just want to quickly wrap that off, Tim, with just one question. What are some of the risks that you foresee for AvePoint at this stage?
Yeah, so I think AvePoint, one of the key risks, as I said, with Microsoft, I think I guess it's a benefit and a risk, is it's got that large addressable market through Microsoft. But if Microsoft's internal processes or the way they sort data and they work with partners changes, then that could impact AvePoint as well. So, or if they start off their own competitor internally, right? That also can threaten AvePoint's business, given it's so closely integrated and tied in with Microsoft. Beyond that, valuation compression is a concern. It's trading at around 8 times sales right now, which is pretty pricey for I'd say a smallish cap software SaaS, cloud SaaS company. One of its key competitors, which is Commvault, is trading at around 5 times, and it has around 3 times more revenue on a trailing 12-month basis. So over the past 12 months, AvePoint's pulled in around 373 million in terms of revenue, and Commvault's just at about 1.05 billion. So it's a bigger competitor, but it's trading at a cheaper valuation. So I think if there is general compression in valuation, or we see a dip in the market and sentiment turns, then I think it could get whacked. So I think it's elevated slightly with valuation. So I think that's something to watch for investors as well.
Brilliant. Yeah, let's watch out for that. But also in a very sweet sector right now, AI, which is one of the key sectors for many investors and top of the mind. Alex Ferber asks, how to kind of get some exposure into AI in Southeast Asia. I think AvePoint and the SaaS sector is probably one of them, along with Keppel DC, REIT, Singtel, which are some of the stocks that we cover as well. Thanks, Tim, for that. I want to quickly highlight from our chart guy, we've got two trading buys. Metaoptics is showing strengthening momentum in its current bullish reversal phase. Do look at the chart today on the newsletter. We also got Everglory United Holdings. Breakout there could be imminent. So do have a look at that as well. After all that discussion on SaaS and cloud stocks, I just want to highlight a very special promo we are running right now. Now until the 31st of January, you stand to win a $20 shopping voucher when you execute trades on SGX's SaaS and cloud stocks. These stocks are AvePoint, Asia Systems, and Infotech Systems. Read our newsletter today for more details. Unfortunately, we've run out of time, so thank you so much for joining us today, and thank you for your support. As always, have a profitable trading week, and we'll see you next week.